चलिए, it says that the warrants are financial instruments that provide the holder with the right to purchase a predetermined number of rates. Warrants are form of debt instruments that obligate the holder to buy a specific number of shares. Both the assertion and reasoning are true. Both the assertion and reasoning are true, but there is correct or incorrect information. It is true, but reasoning is false, or assertion is false. What's the correct answer, everyone? The warrants are financial instruments that provide this, and second is they are a form of debt instrument. This is actually a kind of debt instrument where there is an obligation. It comes up with an obligation that you will have to pay to that particular person one or the other way. Okay, here comes the next question. Again, an assertion and reasoning based questions. In the case of preferential allotments in India, buyers of warrants have to pay the full warrant upfront. This upfront payment is non-refundable regardless of whether the warrants are exercised or not. When we talk about the preferential allotments in India, buyers of warrants have to pay the amount upfront. And is it non-refundable, whether it is exercised or not? It's not exercised, there is nothing, there is no point of charging the money there, na? So one thing is true that when we talk about assertion, assertion is correct. But when it comes to the reasoning, reasoning is false. First thing is correct, but this is wrong. Okay, so in this case, I can say that both are correct. No. Both are correct. Again, no, I think I'll go for C. Assertion is true, but the reasoning is false. So that is, assertion is true, but the reasoning is false. Done, everyone? Next question. What is the primary characteristic of a warrant? It obligates the holder to buy a predetermined number of equity shares. It gives the holder of the right to buy, not an obligation to buy, right? It is not an obligation, but a right to buy the equity shares. It offers fixed rate of interest. It provides the holder of with voting rights of the company. In terms of warrants, na, the shareholder is basically assured कि sir, currently though I cannot give you the shares, I'm sorry, but maybe in the future we can provide you. So I assure you that part, that when we will be having shares of the company, na, we will give you, right? So is this an obligation or a right? So in this case, what would be the answer? When it's a right, not an obligation, what will it be? when it's actually a right. Vesena, it is always a right, not an obligation when it comes to warrant. Even in the dividend area as well, now once we talked about the area of hybrid and all, now it is something which is there. It gives the holder the right, but not an obligation to buy at predetermined rate. Predetermined means this particular rate is already decided. Ki, acha, these are the number of shares, and this is what we want to do with them. Okay. Why are warrants sometimes attached to debt instruments? To require the holder to convert the debt into equity, to make the debt instrument more attractive, to increase the interest payments on the debt, to grant the holder voting rights in the company. What would it be? When we talk about this enough, why are warrants sometimes attached to the debt instruments? See, this is basically now. Warrants are basically a right, isn't it? This is not something that we are making sure that it is there. But when we are adding it to a debt, first of all, we are raising loans from the market, but we are also offering them a share, a right that they can use later on. This becomes more attractive for them, isn't it? Now they can have the shares of the company later on. So, this is something which would be more attractive to them, because ultimately you get a debt plus option of having equity in the future. So in this case, people who didn't even think about buy the they were not thinking about buying the particular debt or investing in that company, this particular offer looks more lucrative to them. One plus one free definitely attracts other people. So in this case, the correct answer would be to make the debt instrument more attractive to investors. In context of the warrant pricing in preferential allotments in India, what is the purpose of the floor price for warrant conversion? What is the purpose of the floor price? When we talk about to set the maximum price of the warrant to ensure that the warrants are never exercised, to protect the interest of minority, or to encourage more companies to issue warrants. See, when we're talking about the floor pricing, we are looking forward towards a specific pricing for these areas, huh? And we are looking forward towards preferential allotment. Matlab, we will choose the people to whom we are giving the warrants. Doesn't this mean that we are making sure our equity is not kept blindly? Point is, these people have the right. Maybe in future they would change towards equity. Once they become an equity shareholder, if their shareholder becomes their shareholding becomes too much, they can take decisions regarding everything. And I'll be standing there onto a side thinking that, array, my business is gone. Why would I want that? So in this case, there is no maximum price of foreign conversion. We would be looking forward to it. We would never want that these are never exercised. Why would we issue if you're thinking about that? Right? To encourage more companies to issue warrants is never the point. Why are we looking into other organizations? We are looking at the fact that if I see, the point is, I know A, B, and C. I have asked B ki B, you can you have a specific number of extra shares? B said, yeah, I can have. So in the future, he has an option to have more shares. Right now he doesn't, but maybe in the future he can take up more shares. So even if he takes up more shares, he is still being the person who has good number of shares of the company. So he still holds a decision making. Then this is good now. So basically, the people who the entire warrant system, when converted into equity, it should not change the composition of the majority and minority altogether. If the game is changed altogether, it can create a lot of problems. That is why if you are making any preferential allotment, right, it's just to make sure that the minority shareholders are not affected by it. Okay, na? Next portion. In the early 1980s, how were convertible debentures in India typically required to be converted? Compulsorily and partially at the discretion of the debenture holder, only after the credit rating was obtained, or after minimum of 36 months. In terms of the debentures, na, they both the things were there. You can be compulsorily moving it or partially converting it. You can convert it into debentures, or the debentures can be converted into equity, but it was always at a predetermined rate. Okay, it is always at a predetermined rate. It is already defined. Which regulatory authority had control over the term of convertible debentures before SEBI? Okay, I just gave you a point there. Earlier, before 1992, SEBI didn't exist. So, what was that particular organization which existed in terms of stock exchanges? The SEBI came in 1992. So before that, was it controller of the capital issues, RBI or Ministry of Finance? Ministry of Finance was never the one who was looking after all these. RBI was never looking forward about this. SEBI just came later. So in this case, the correct answer is B. You can use the portion of elimination to do these questions as well. It was controller of capital issues. Okay. What major regulatory change in India occurred in 1992 after convertible debentures? Acha, what do you mean by convertible debentures, everyone? The debenture holders who are given the debentures which can be later on, not right now, but later on can be converted into equity shares. You know, the introduction of SEBI, the imposition of stricter credit rating requirements, the requirement for all debentures to be fully convertible, the extension of conversion period to 60 months. What would be the answer? Basically, now, in wherever you find 1992, one of the basic things that happened in 1992 was making up of SEBI. Coming up of SEBI made the particular transparency in terms of working all together. They've made sure that the entire country is working, excuse me, in terms of securities in a very transparent manner. They wanted in the transparency in this area. They started with the screen-based trading, and later on, demat accounts are maintained. This particular exchange has made the working all together more systematic. So in this case, it is the introduction of Securities and Exchange Board of India, that is SEBI. Okay, here comes the question, everyone. Assertion is both warrants and convertible debentures confer a call option on the equity stock of corporation. Acha, call option is company has the right to ask the people ki sir aa jaiye, please let me make the payment for you. And then put option is basically in the second case, it is like in the case of convertible debentures, the debentures and the options are inseparable. Does this happen? This happens when we talk about convertible debentures. This is at the discretion of the company what they want to do. Currently, now they have. In case of convertible debentures, that means they have the choice that do you want to convert these debentures into equity shares. Convertible means which can be converted. You know? So we're looking forward towards which can be converted further. So both assertion and reasoning are true. The reasoning is correct. Both the assertion and reasoning are true, but it is not correct. The assertion is true, but reasoning is false, or assertion is also false. So I think in this case, since we're talking about the convertible debentures and the this particular thing, convertible means which is converted, na? So that means in this case, the correct answer would be A only. Both of these are correct. It is the company which makes the decision that yes, sir, we have money, we can give you, sir, we do not have money, so we are giving you debentures instead of anything else. This happens. Basically, now when we talk about debentures, now debentures can be called as convertible and non-convertible. What's the difference between the two, everyone? Under convertible debentures, we can the company when while at the time of redemption they can decide कि नहीं, we're not giving you cash. If we earlier had debt or from you, instead of making the payment, let's make you the owners of the organization. We are issuing equity shares. So now you will no longer receive interest, you will now receive dividend. That's the entire scenario regarding convertibility there. Okay. Non-convertible is at the time of payment. You pay in cash. There's no other way through which you can pay. Oh. At the time of payment, you pay in cash. Done, everyone? Next point. I hope all the points are visible. Now, have a look at the question even. Assertion is given that warrants can be issued independently without any association with another financial instruments. Or convertible debentures are typically issued as standalone securities. Warrants are basically can we can issue only debentures and we can issue only warrants. This is allowed. You can have any of these. Convertible debentures are typically issued as standalone securities. Normally, they are issued like that only. There is no reason to have both of these together. Convertible debentures plus warrants, they cannot be issued compulsorily together. Okay? Both the assertion and reasoning are true, and the reasoning is the correct explanation. Both the assertion and reasoning are true, but reasoning is not correct. Assertion is true, but reasoning is false, or the assertion is false. I would say both of these can be issued individually. Debentures are something that we are trying to raise money from the market. So the loans can be raised at any point of time with any amount of money, right? So there is no compulsion ki nahi, warrant should be there. If I say that with one particular pen, refill is free. Now even if I sell the refill separately, no problem. Even if I give the if I sell the pen separately, no problem. It's just that we are giving it together. Debentures and warrants when given together becomes more attractive, but that doesn't mean that these things cannot be working independently as well. So in this case, both the assertion as well as reasoning are true, and the reasoning is the correct explanation of the assertion, right? Done. Let's move on towards the next question. Today I've got a lot of questions which are based upon reasoning and assertion. I think by the time this examination would come, you will be having good number of questions there which can be based upon reasoning and reasoning and assertion. Then it can also be based upon match the following. Then they have the area fill in the blanks with the MCQ format. And it has been stated even that theoretical questions, there can be questions regarding fill in the blanks as well, but pure fill in the blanks would be asked only in terms of numericals as given by the CAIIB there. So this is expected that in the examination you will have these set of questions, right? The question, it says assertion Both warrants and convertible debentures confer a call option on the equity stock of corporation. Reasoning is, in the case of convertible debentures, the debenture and the option are inseparable. Now, this is similar to the point we have talked about. Okay, I think we are done with this question specifically. But when we talk about this area, it is talking about warrants and convertible debentures. If you give them together, it's good because it becomes more interesting. But if you give them separately, there is no problem even. No? In case of convertible debentures, a debenture and the option are inseparable. When we are putting this particular convertible debentures, then we are giving them the option as well, right? That option in terms of the converting them into equity shares or the cash. That option is still there. And yes, it is inseparable because the condition of convertible means it can be converted. So in this case, both are correct. There is no hard and fast rule that it has to be converted. It can be converted. Next question, everyone. Which of the following is the key difference between the warrants and the convertible debentures? Warrants can only be issued with debentures while convertible debentures can stand alone. Convertible debentures can be exercised for monetary compensation. Warrants resulting in accounting transfer while convertible debentures inject additional capital into the company when exercised. Or convertible debentures can be separated from the call option they confer, while warrants cannot be separated. So I would say, Acha, we have just talked about this topic a lot. So there is one particular thing. What is the key difference between warrants and convertible? Warrants can be issued with debentures while convertible debentures stand alone. This is not true. Most of the time, warrants and convertible debentures can be issued together. Then comes convertible debentures can be exercised for monetary compensation. Convertible debentures will never give you more flow of money. It's just that he was earlier your debenture holder, now he's becoming an equity shareholder. So in both the cases, you're not getting it. Warrants result in the accounting transfer, while convertible debentures inject additional capital. In both the cases, you get money. In one, you get a loan, in the other, you can get equity. But that is a right to get equity share over the period of time. So, one thing is true, convertible debentures can be given separately while warrants cannot be. In this particular case, right? So, the point is D. Convertible debentures can be separated from the call option they confer, while warrants cannot be separated. This is one of the key differences among the two. In case of warrants and convertible debentures, which of the following is true? Warrants can only be exercised for additional shares. Convertible debentures can be issued independently. Both warrants and convertible debentures can result in injection of capital, or warrants are typically issued as standalone securities. See, this question is very similar to what we have had earlier. It's just a change in the statements there. In this case, I would say the first point. Achha. Warrants can only be exercised for additional equity shares. No. Convertible debentures can be issued independently without association with another financial instrument. Convertible means you have equity involved in it. So you cannot blindly say this. Then warrants are typically issued as standalone. No. They are many times with the convertible debentures. So in this case, the correct answer would be C. How do these work? They have a blend of debt and they have a blend of equity. They have both of these there in their working. So, how do they work? In terms of debt, we are looking forward towards long-term loans. In terms of equity, this is the owner's money, and hybrid is basically having something in between these two extremes. So that can be called as hybrid finance. When we talk about the hybrid finance, these are the further questions that we're going to talk about today. One of the hybrid finance or hybrid securities is the preference shares. Preference shares have got a defined percentage of dividend, okay? And at the same time, when the organization is dying, at liquidation they have a preference, but they do not get the leftover or something. They have a defined percentage. The dividend is already the dividend is given to them, but there's a surety about it that this would be the amount that would be charged from them. So, what is the key characteristics of cumulative preference shares? They offer variable rate of dividend, dividends accumulated if unpaid. They grant voting rights in the company decisions. They are always irredeemable. The ones which are irredeemable are called non-redeemable are called irredeemable. They grant voting rights. There is no specific preference shares. There's a voting right or something. They offer variable rate of dividend. They do not, right? So in this case, the correct answer is dividends if dividends accumulate if unpaid. For example, D1, D2, D3, D4, D5. This is the dividend that they will receive over the period of time. In the first year, in the second year, in the third year, they were able to pay. In the fourth year, they were unable to pay. So maybe the inadequacy of funds would have arisen. So because of this, they would have faced a problem. So when they would have faced a problem, then in the year 5, they will pay D4 plus D5 together. Right? Next point. If the dividend is not declared for a year, what happens to the right to receive that dividend in non-cumulative preference shares? The right is retained for future years, the right is forfeited for the year, the dividend is paid from the company reserves, or shareholders can vote on the distribution of dividend. If the dividend is not declared, the right to receive dividend. Actually, everyone, one thing is true that if the dividend, there's a right to receive. There's not an obligation from the side of the organization. This is basically something you have the right. If the company is making profit, then you have equal right to receive the money here. In case the company is not making any kind of profit, then you cannot crib about the fact that the company is not paying us. If they have profit, they will give you. If they do not have a profit, then they do not owe any money to you. So in this case, can I say the right is retained for future year? No. The right is forfeited. Why? Because this is non-cumulative. Non-cumulative means the one in which the share value is not collected. Okay? So in this case, the correct answer would be the right is forfeited for that year. What distinguishes participating preference shares from other types of preference shares? They are non-redeemable. They offer fixed dividend rate. Shareholders can participate in surplus profits, or they have no voting rights. What distinguishes the participating preference shares from other types of preference shares? Participating preference shares can be differentiated from the other ones as, in terms of participating preference shares, they get the surplus of. Okay, for example, the organization made a super surplus. First of all, it paid the preference shares a chunk of the amount that they were supposed to. Then this huge amount was left for equity. So this preference share really had a greedy thing in his mind. It was like a lot of money going to the equity shares. They said, yeah, this year we had made super profits. So we have defined and given you the money that we were supposed to give to you. After this, whatever is left is our super profit. What do you want to do with super profit? I said, if there's so much of super profit now, I need chunk of this as well. So after I've received my basic dividend, I want another chunk. Now this chunk is because I have bought participating shares. Participating shares means you get super profit share as well. After getting your basic share value, you can still have more money just because the company has made a lot of profit and the entire amount would have gone to equity, but you have paid more, you have bought this kind of share, so you have the right over that super surplus as well. So in this case, it's not about the dividend, it's not about redeemable, or it is also not about the voting right. It is about shareholders can participate in the surplus profits. That is, shareholders can participate in the surplus profits. Acha, whatever questions I'm making are exclusively from the Macmillan book only. So what you can do is whenever you get time, you should go ahead and practice these questions accordingly. Right? So kindly keep a check on it every single day I'm coming up. Right now I've just started with module D. I had finished the module B and C completely on the YT there, and now I'm starting with module D has just started. Right? So please make sure that you are keeping your updates there. Chaliye. Next question. What is the primary characteristic of non-participating preference shares? What is the primary characteristic of non-participating preference shares? Non-participative preference shares are those they offer variable rate of dividend. Shareholders can participate in surplus profits. They have fixed dividend. They are not convertible. They are convertible into equity shares. These are called convertible preference shares. The one which can be later on converted into equity, they are called convertible preference shares. So in this case, since they're talking about non-participating, the one do not want surplus, that is B. They do not want it. Acha, sorry. This is the shareholders can participate. This is for participating preference shares. So in this case, the answer would be they have a fixed rate of dividend. It's too much focus upon what we didn't want. Then everyone, they have a fixed dividend rate. Next point, under what condition can a company redeem the preference shares? Can these preference shares be redeemed, everyone? Redeemed means the one which are paid off. Only on liquidation or shutting down at the company's discretion after the holders vote of for redemption or on the anniversary of their issuance. There's nothing on the anniversary of their issuance. It can be issued or it can be paid off before as well. The ones which are perpetual in nature, the one what condition can redeem? We can redeem only when we are actually shutting down the operations or liquidation. This is exclusively for the world. There in our country, we also issue irredeemable preference shares. These kind of shares which can be liquidated only at the end of the life of that asset, they are called irredeemable preference shares. After we have irredeemable preference shares, we have something which can be paid off during the lifetime of that particular company at any point of time, maybe after 20 years, maybe after 10 years. So those kind of the ones in which we pay off them within one particular year, we call them within a specific period of time. There is no specific 1 year or 2 year or 3 year. The one which we pay off, they are called redeemable preference shares. In terms of redeemable preference shares, we have a maximum period of 20 years. Then, in our country, we can issue redeemable preference shares. Irredeemable preference shares are not allowed. Irredeemable preference shares are not allowed, and the one which are allowed, even they can be issued only for a specific period of time of 20 years, not exceeding that. So in this case, the correct answer would be only on liquidation or shutting down of the operations. While in our country, as per Companies Act 2013, you cannot issue preference shares for more than 20 years. So redeemable preference shares up to the year of 20 years max. In which country are irredeemable preference shares not allowed to be issued by the companies? US, India, UK, Canada. As I just told you, in our country, we do not allow to issue irredeemable preference shares. Only redeemable, the ones which can be paid off during the lifetime. That means they are only redeemable in nature. In our country exclusively. While it exists, irredeemable, redeemable, different types of assets are there, preference shares are there, but in our country we have only the redeemable ones, the one which has to be paid off. Maximum time tenure 20 years, as per Companies Act 2013. Okay, let's continue further. The answer is India. Okay, what distinguishes convertible preference shares from non-convertible preference shares? What's the difference between convertible and non-convertible, everyone? Is it convertible shares grant voting? Non-convertible shares offer a fixed dividend. Convertible shares can be converted into equity, or non-convertible shares have no fixed dividend rate. Done? What would be the answer in this case? What distinguishes convertible preference shares from non-convertible? Convertible are the one in which you can pay off them in cash or partial payment in cash and you can give shares. While in case of non-convertible preference shares, once it's a preference share, it remains a preference share. It cannot be converted into any other form. Done? Done, everyone? What distinguishes the convertible preferences? Convertible ones which are can be converted into equity. The ones which cannot be are called non-convertible. So convertible grant the voting rights. No, there is nothing to do with the voting rights. It has something to do with the dividend. No, nothing to do with the dividend. This can be converted into equity shares. So maybe in future, not right now, you can become the owner. Becoming the owner of an organization is definitely giving an edge now. Done? Convertible shares can be converted into equity shares. What are adjustable rate preference shares known as? Known for offering a fixed dividend rate, having a variable dividend rate, being non-redeemable, or granting voting rights to the shareholders. Adjustable rate. Adjustable rate means the rate of dividend is in our hands. है ना? As I told you, in terms of preference shares, normally they have a fixed rate of dividend. If it can be changed, so this is not about having a fixed dividend. That is not even having a non-redeemable, or it is not about the voting rights as well. This is related to having variable dividend rate. Next question. What is the maximum limit of perceptual non-cumulative uh, preference shares? PCNPS. in additional tier 1 capital concerning risk weighted assets? 2%, 1%, 3%, or 1.5? Which one is the answer? What would be the answer, everyone? Is it 2%, 1.5, 3, or 1? In this case, the correct answer would be 1.5%. And everyone? Chaliye, here comes the next point. Regarding these specific nature, what is the nature? Perceptual non-cumulative. Non-cumulative means if the dividend for one specific year is missed out, then the dividend in the next year will not be available in terms of the non-cumulative. Non-cumulative means if we fail to pay dividend in one particular year, I'm sorry, the same dividend will not be accumulated and would be given in next year. You will receive only the dividend for the next year exclusively. Perceptual means which goes on. So in this case, when we talk about perceptual, they have a predetermined maturity rate. They offer step ups for increasing the returns. They can be redeemed at any time. They have no maturity date or step ups. What about PC and PS? In this case, what would be the answer? Perceptual means which goes on and on forever, right? We don't know the end of it. So the answer would be they have no maturity rates, date, or step ups. The answer is they have no maturity, date, or step ups. They have nothing in terms of this. Okay? That's the answer. Done, everyone? Okay, next question. Under what circumstances can the bank exercise a call option on PCNP, CPS? Perceptual non-accumulative preference shares. They can be exercised at any point of time without restrictions after a minimum of 5 years with RBI clearance if the dividend reset date is the same date as the call date whenever the bank wishes without any conditions. When we talk about these perceptual means which goes on, right? And non-cumulative means not collecting of the dividend in case there's a default, we will not be able to pay it. But in these cases, call option where the company can call upon the shareholders and can ask them, sir, we have got money, can we pay you off as we would love to? So in this case, they can do this, but after minimum 5 years. And RBI should agree to it because obviously certain investments are stuck in it. It is better that you should not be blinded by the fact that there is a minimum time period and everything else stated. So it's better in this case. Normally, you have this particular scenario that after a minimum of 5 years with RBI clearance, this PCNPS can be called for. Call means right to call is basically to call the people to pay back, to get their money, and we will get preference shares. ठीक है ना? If we have issued preference shares, we will be redeeming it and then we'll be paying off the money before time. Our benefit, we would have got money already. So there is no need to run the debt anymore. So let's move on to the next question. The next question says, how should PCNPS absorb the principal losses? When they face losses, what should they do? What is that particular thing that they can do? By paying out cumulative dividends, by paying off the cumulative dividends. This is non-cumulative. By cumulative means to collect whatever amount we could not pay in the previous years, we'll collect and pay it off this year. By converting to common shares, by increasing the coupon rate, or by offering step up incentives. See, in this case, if the PC NPS is based, there are losses there now, then it is way better that, see, whenever there are profits, they get it because they are the owners of the organization, right? So they are also, in terms of losses, what can they do? When there are multiple losses for the organization now, then at that point of time, it is better to convert into common shares. Rather than being preference now, it is better to convert to the common shares. But this should be done when once you are thinking about the end of the organization or you want to change its face altogether. This is by converting to common shares. Next point. What should purchase PC? Who should purchase PC NPS according to the provided term? Bank and related party, an individual, only Indian government, or neither bank nor the related party. Who can buy these? See, this can be issued to anybody, but always remember the related party cannot be the one, and even banks are not allowed to use it. Related parties are the parties which have influence over the organization. For example, key managerial personnel. If the key managerial personnel has a particular place outside somewhere, that is also covered here. For example, if I am a key managerial personnel and I have got my own company out there, and my company is also dealing with this company, and then maybe I am receiving a lot of salary, whatever my salary is, that is also my money there. If I buy and sell something for the company, then arm length price should be determined because I am a related party there. And if I show my interest on that particular thing, what will they do? That is another point that I have to consider. There are many things that has to be considered when it comes to this area, no? So the related parties are, they can turn out to be biased towards the organization. That is why we are not going to choose either the bank or the related parties. So in this case, the correct answer would be neither the bank nor the related party. Okay, so let's begin with the session. What am I going to discuss? Hybrid finance. Hybrid finance means financing form. It's a form of financing that means to acquire financing, I need a specific source, right? If I'm trying to acquire money from you, then I need to have a specific kind of financing, which is not a mixture, isn't it? Or is it? Let's look at the primitive form of financing were basic. Na? One is extreme. That there are two extremes. One is using your own money only. That is equity. And what if I'm not using my own money? That means I'm taking loan from anybody. That is debt. These were two extreme corners. One is using the own capital, one is using the other people's money. This is own capital. This is others' money. Now, both of these things are defined. In between or anything which has the qualities of both equity and debt is termed as hybrid finance. है ना? Hybrid means the which is not purebred. It is something which is a little better than both of these. Plus point of both of these, equity means your own money, unlimited returns. Nobody else can ask you about the returns at all. Plus point is this only, na? So when we talk about the hybrid, first is equity, second is debt. Equity can be stated as something in which we are having our own money, so residual, whatever is left is all ours. In terms of debt, whatever happens to the company, company lives, company dies, company gets burned, company goes through bankruptcy, nobody cares. Debt clearly says if I've given you money, you give me my money back. Even if you're in your crunch moments, you are supposed to pay me. Of course, there's a ranking for debts as well. Primary debt, secondary debt, all those things are there. The ones which are in terms of priority would be paid first, and the one who are secured would be paid first. But in terms of debt, they are prioritized. Then, if we are not able to pay the loans, that money will be recovered as areas of law, areas of land that you haven't paid the money, you give me money right away. That is the power of debt. Equity is like companies are making profits right now. Now, it's absolutely fine. When it starts making profit, then give me money because they are the owner now. So owner would always take care of the risks. He will understand the returns. He will look forward towards the matter the way nobody else will, isn't it? So let's talk about it in detail. Here comes the first point, everyone. When we talk about this point, that is, why do hybrid securities typically offer a higher rate of return compared to pure debt securities? Lower credit rate, risk, less volatility, regular, predetermined return, or greater liquidity. Everybody, why do hybrid securities typically offer a higher rate of return? If we talk about pure debt securities, there is a defined rate. Okay, sir, ma'am, you will receive this much amount of rate only. There's nothing else that you will be receiving. This is something that we have a particular. In terms of debt, there is a coupon rate which is defined, interest rate. But when we talk about hybrid is basically preference shares. One of the hybrid is preference shares, which says just like equity, you have having shares. Just like equity, you are also the owner of the company. Just like equity, you can also sit in the AGM. But they have a right over dividend before equity. And when the company dies, they have a right over liquidation money before equity. So basically, this is that jealous kid of the family who says, before giving anything to equity, give it to me. He's the kid of the family only. That means he belongs to the company only. He's not an outsider like the debentures or the debts. They are an insider, but jealous of his elder brother. That is equity. He'll always be like, give me money first, give me a food first, give me if the family is being partitioned, then give me my share first. So this kid is gonna cry at every single level. But then if this kid is going to cry, he will pay more too. Because in our country or what, I think in the entire world, if you want more, you will have to pay more. So obviously, he is also shedding out more money when he is looking forward towards preference shares. So what are they doing? Pure lower credit risk, less volatility, regular predetermined return, or greater liquidity. I would say in terms of hybrid securities, they offer a higher rate of return because of the regular and predetermined return. This is why they do it as compared to uh, the area of debt. This is something which they do. So there is a regular return and that is predetermined return as well. So this is the point regarding the hybrid securities. What is that one of the advantage of hybrid securities with regard to market price volatility? Market price volatility, see, the market never remains the same, does it? It doesn't. So what are the advantages of hybrid security? They offer a fixed interest rate, they do. They have a higher liquidity, they are less volatile, or they have tax advantages. What would be the answer in this case? Which one of the following is with regard the market price volatility? Market price never remains the same, you know. So, but in terms of the securities which are hybrid now, they are somewhat more stable. That is what I can say. They offer what are the advantages with regard to market price in terms of market price volatility. Volatility, they are less volatile. Okay, they have a fixed rate of interest. Again, they have it in terms of preference shares. You have a defined dividend percentage. Then they have tax advantages. No, preference dividend doesn't have a tax advantage. You can never cry that you are paying for your kids, right? other than the school fees that you are paying, whatever your amount you are spending on your kids, you cannot cry in front of income tax department and ask for a deduction out of it. You know, so that means once you are paying pocket money to the kids, it is not covered under not taxable amount. So in the same case, when the company earns, it pays income tax on the profit, and then whatever is left is given to the two kids, equity and preference. It is, they are less volatile. In terms of preference dividend, equity dividend, there is no tax advantage. They just have an advantage in this area that they can be really helpful further. Then comes, how can hybrid securities contribute to risk diversification for the issuer? By being strictly defined as equity securities, by having a regular predetermined return, by being a combination of both equity and debt features, by having a maturity date. How can hybrid securities contribute to risk diversification? Diversification doesn't mean reduction. We're just spreading it up so that even if there is a risk in one particular area, the other particular thing will try to reduce that part, right? We are splitting it up, spreading it up. By strictly defined equity securities, no, it is not. Hybrid are never pure equity. By having a regular and predetermined return, that is something that is helpful for them, for the one who is getting these hybrid securities, not for the company. You know, in terms of issuer, he is someone who is having the combination of both equity and preference debt. Now this is where they talk about preference shares. So the answer should be C. The most apt answer would be C, by being a combination of both equity and debt features. Next question. Why is the assessment of return on hybrid securities more complicated than on equity or bond securities? Hybrid securities have a lower yield, they have a fixed period. Calculation of the returns of hybrid securities is complex, or they are not traded in the market. They are traded in the market. Their yield can be lower than equity because equity gets a good money, agreed. But hybrid securities have a maturity date which is fixed, it depends, right? So calculation is something which I'll agree that it is more complex. So that is one of the reasons that becomes that these securities are very difficult to find out, right? And everyone, moving on to the next question. The next question says, what type of hybrid security gives preference shareholder a higher priority claim and on the income and assets? Convertible debentures, warrants, preference shares, or mezzanine financing? What type of hybrid gives preference shareholder a higher priority? Actually, this question itself is an answer to it. Preference shares are the ones in which you have a higher priority over equity. What happens is, in terms of the organization of preference shares, if it has equity and preference, while distributing dividend, they get dividend before equity. While the company is liquidating, they get money before equity. And at the same time, in terms of preference shares, there is a defined interest rate, or the what I can say is the dividend rate as well. Plus, always and always remember, in preference shares, you just have the right uh, towards the right to receive dividend. There is no compulsion from the company that they have to pay dividend, but you have the right to ask for dividend, and the company should pay you whenever it is making a profit. But in case of losses, you cannot press the buttons of the company to let you to provide you the dividends. So at that point of time, you cannot do anything. So if the company is paying dividend, you can receive. If the company is not paying dividend, then you cannot receive anything. Okay? You get it once at the time of receiving, you might be having a priority, but not on normal basis. Acha, based upon that, one more question that nobody has asked me yet, that is mezzanine financing. This one is hidden. Visible? It's called the mezzanine financing. How do we define mezzanine? Under mezzanine financing, they say that under mezzanine financing, they say that whatever your income would be, sorry, it is about the debt there. When we talk about mezzanine, mezzanine means that in a normal case, till the time there is no default from the time from the area of the company, there is nothing to be done. The moment the company makes a default, after that the uh, the debt becomes very very important. Till the time the company is not a defaulter, not defaulter, then you cannot interfere in the working of the organization, you cannot ask for anything. But once the company defaulted, then the security thing hits in. That is mezzanine financing. Next point, which type of preference shares guarantees a dividend payment and accumulates unpaid dividend if not distributed? Which one would do this? Think about it. This is different types of preference shares. Cumulative, non-cumulative, convertible, and participative. Acha, this is about accumulation of the dividends. If not paid in the first year, then in the second year you will pay D1 plus D2. This is not a compulsion, but in a certain type of preference shares, it is a right. It is cumulative. Cumulative means to collect. Non-cumulative means if I could not pay you in D1, then you just have to pay D2, then D3, then only D4. Once it is missed, it's missed. Done, everyone? The answer is cumulative preference shares. Acha, in terms of mezzanine, let's simplify it further as well. In terms of this, till the time there is no default from the company, then it is still a debt. The moment there is a default from the company, as soon as the company makes a default in paying the debt, it becomes it. They have the right to convert into equity shareholders. They can become the owners of the company. Okay, they can become the owners of the company. Next question. What type of hybrid security allows the holder to purchase common shares at a specified price within the certain time frame? Convertible debenture, foreign currency convertible bond, mezzanine, or warrants? What would be the answer? What type of hybrid security allows the holder to purchase common shares at a specific price within a certain time frame? Warrants aren't shares, everyone. It gives you a specific right to buy shares. Convertible debentures means the debentures which can be converted into equity or preference. Foreign currency convertible bonds, it's a kind of bond, again a kind of loan. Mezzanine financing, we just talked about it. In this case, you are getting the right, isn't it? You have the right to get shares of the company at a certain price in within a certain time frame, within a specified time. So, can we say the answer is warrants? Warrants are issued when the company doesn't want to issue the shares, or they do not have the shares for issuing. So that is what they will do. Okay. Next point. Visible clearly, everyone? In which type of hybrid security does the bondholder have the option to convert the bond into specified number of common shares? Preference, convertible, mezzanine, or FCCB? In which type of hybrid security does the bondholder have the option to convert the bond into a specified number of common share? Bond can then be converted into shares. Quick tip, we talked about it just now. The previous question, we talked about it. First is preference shares, second is convertible debentures, mezzanine, or FCCB. They're talking about the bondholder convert the bond into shares, that is convertible debentures. Convertible debentures can be converted into equity shares. Na? These are initially they are debts which can be converted into equity. The answer is convertible debentures. In liquidation scenario, what is the advantage of preference shareholders over equity shareholders? They have higher claim on dividend. They have higher priority in receiving their share of assets. They can push the company into bankruptcy, or they have higher voting rights. They can never have a higher claim over dividends. They will get their fixed rate. They can never have, they can not push the company into bankruptcy because their money is not land areas at all. The kurki can be done, or the selling of the assets and everything is in the hands of the debt. They have the right, but not the shares. They have voting rights, they get voting rights. As such, they do not have any voting rights. If the company fails to pay them for 2 continuous years, then they have voting rights. Otherwise, normally, they do not have any voting rights, right? They can call their specific class meeting, but they do not compulsorily call the entire company to for the AGMs and all. So in this case, the correct answer would be they have the priority in receiving their share of assets. Remember, preference shareholder has a preference. They have a preference over equity. In what ways? First is preference shareholder have a preference in terms of two things. One is at the time of dividend and at the time of liquidation. They have a priority receiving their share of assets. After debt, of course, first of all, taxes are paid, then the debts, then then comes the era of any outstanding expenses for the employees and all. Then we will start looking forward to equity and preference. Not before that. How can preference shares rated in the terms of creditworthiness? By credit rating, by equity, by government, or they are not rated? How will you find it out? Our preference shares rated in terms of creditworthiness? They are rated by the credit rating agencies. And next question. What is the key difference between junior and senior classes of preference dividend? Junior class have higher voting rights. Senior have higher dividend. Junior classes have a priority in liquidation, or senior classes have priority in voting. Basically, juniors and seniors have been created because of the fact that there are certain class of shares which are little different from the others. Right? So they're talking about the difference between the junior and the senior one. Done? In this case, the correct answer would be senior classes have higher dividend rate. They have a higher dividend rate. Every class of shares varies. Okay? Can the preference shares have a maturity date? Yes, they always have. No, they are never issued on maturity with a maturity date. It depends upon the company's choice. Only seniors have maturity date. At the international level, it depends on the choice. But in our country, if I have to specify, it cannot be for more than 20 years. It's the rule of the market. If I talk about the Companies Act 2013, it states that you cannot issue preference shares for more than 20 years. So by the max 20 years, you will have to pay them off. Okay? That is the point to be covered here. It depends on the choice at the national, international level. But in our country, we can only issue redeemable preference shares, not irredeemable. So those in which you have to pay after a certain period of time, they are called redeemable preference share. And everyone, chaliye.
See, I want to grow further. I am an Indian company and I can't enter the company which is outside India. So I decided I want to enter the US market. So what I did was I bought a particular organization in US and I'm trying to work over that. That is what we call in terms of deal structuring and financial strategies. So when we talk about this era, it is totally based upon the fact that we are looking forward towards buying another organization which is not in our area, but we still buy that organization because it can benefit us in such a way that if I try to enter that market directly, it won't work out. But if I enter that market through the other organization, it will definitely help me. So that is the kind of thing. So now we are talking about two different countries. When we talk about two different countries means two different ideologies. Two different ideologies means two different laws as well. And two different laws means if you are trying to enter that market, you have to know ignorance of law is no excuse. Specifically in our country, it is stated that if you say that I didn't know the law, that will not work out. So based upon this, here comes the first question. What is the purpose of bilateral? Bilateral means a particular thing, a particular contract which is made between two parties. Bilateral double taxation avoidance agreement, that is DTAA. When we talk about the DTAA, that is to increase tax revenue for both the countries involved, to limit the tax rights voluntarily and avoid overlapping tax claims, to encourage double taxation of income for cross-border transactions, or to impose the aggressive tax laws of the Indian setting. When we talk about the bilateral double taxation avoidance agreement. Double taxation avoidance agreement means if you are paying in India, the taxation is paid in India, then you are relieved from the taxation that is existing in the area of, for example, USA. Then if you have paid in India, then you don't have to pay there. So in this case, this really helps you to specify your income, and you will get relief if you are paying in India. Then you will get relief in USA. If you have paid in USA, then you will get relief in India. So basically for both the areas we are doing it. But we make sure that this is done to limit the taxing rights voluntarily and avoid overlapping of claims. That means if you have taken a claim in India, then you cannot take the same claim in USA. For example, I am in India and the same income is earned by the person. He has two places to work, so he is taxable in both the areas. So what happens is, in India he is paying tax. So in this case, since he has paid tax, this is availed in India. So this particular relief can be available in US as well, but he has to pay tax in India. So for USA it will be a relief. For any tax which is paid in USA, he can claim a relief in India. But this should not happen, that I take a relief here and I take a relief here and no tax payment is there. So basically, in terms of DTAA, they always ask that you provide us the details, what you have paid there and what you are paying here, to limit the taxing rights voluntarily and avoid overlapping tax claims. There should not be overlapping from both the sides. Okay? So this is what the first question talks about. Next question, why do most countries recognize double taxation as a disincentive for cross-border trade and activity? Because it encourages foreign investment, because it fosters healthy competition between the organizations, because it discourages cross-border trade and activity, or because it leads to a higher tax revenue. What would be the answer in this case, everyone? Why do most of the countries recognize? They recognize double taxation. Basically, now what happens is as a disincentive for cross-border trade and activity. This is something which doesn't really increases it. Rather, it has a major impact. See that when we are trying to have double taxation avoidance agreements, now there is a lot of formalities with it as well. You cannot avoid it. So when this happens, basic reason that they recognize it, they have to recognize DTAA. If they do not recognize DTAA, then the organizations will be involved in you can say exploitation of the other country, because you are not having any taxation agreements there. So there is a ambiguity in terms of where the country is paying and where they are not paying. So in this case, I would say it will, because they recognize it, so that they recognize it as a disincentive. It's something which is not really good for towards this, because this discourages the cross-border activity, because you have to give a lot of information in terms of DTA. It's not easy to go through the DTA, and the countries with which you do not have the preference there, the overall trading becomes challenging altogether. Right? Okay. Next question. It says, why is protection granted by a country with which India has a DTAA crucial in Indian setting? Because Indian tax administration is lenient, because Indian tax laws are clear and straightforward, because Indian tax administration is viewed as aggressive and the laws are ambiguous, because India does not have any tax concerns in cross-border. Why is protection granted by a country with which India has a specific point there? What would be the answer, everyone? Overall, now the protection granted is basically very crucial for the Indian setting, because now Indian tax laws are very aggressive and the laws are basically ambiguous as well. So this protection is definitely required. Otherwise, sometimes it becomes very difficult for the Indian companies to understand it as well. So for foreign companies, it's another level of trouble. Okay? So the answer would be, because Indian tax administration is viewed as aggressive and laws are ambiguous. There are so many loopholes. So then it is definitely required that to have a protection against this scenario. Right? Moving on to the next point. Here comes the next point, that is, which countries accounted for more than 50% of the FDI in India? China, Japan and South Korea, US, UK and Canada, Mauritius, Singapore and Cyprus, or Australia, New Zealand and Germany? Which countries have more than 50% of all FDIs in India? What would be the answer? More than 50% are of Mauritius, Singapore as well as Cyprus. ठीक है? All these three countries, Mauritius, Singapore, as well as Cyprus. When we talk about Singapore, Singapore is a country which has made itself whatever it is through the FDIs only. It didn't had its own money, so it asked other countries to come and build things for them and earn this from this particular infrastructure which they created, and then they can leave. So in this case, what would happen is, if you prepare a particular infrastructure in my country, even if if both the countries are having a particular dispute, then even you will not fight with me over the fact that I'll take my infrastructure back. You cannot. So in any case, you ask the top-notch countries to come to your country, prepare something for you, earn through that, and then they can go. So you don't have to face a lot of problems, but you just have to make sure you don't get colonized. That's the point. I'm sorry. So here comes the next question. It says, which is one of the key factors that can drive in terms of or impede cross-border transactions? Availability of DTA, aggressive tax administrations in both areas, complex legal procedures, or high transportation costs, which can either drive or impede. What is the thing that will really make our cross-border transactions, double taxation avoidance agreements in a better way, which is basically something that helps in cross-border transactions? DTA. When the DTA is available, people are able to pay, because normally what would happen is, I am paying tax in India, I am paying tax in US, and there is double taxation on me at all the times. This is very, very difficult for me to do that. So what I'll do is, I'll ask them, ki sir, one thing that you can do is, if I pay tax in India, why don't you recognize it? If I pay tax in US, why don't you recognize India? So in this case, I can ask any of the companies to, any of the countries to recognize it, and they will. So in this case, there would be greater chance of me to do cross-border transactions. Otherwise, I am thinking about the fact I have to pay tax in both the areas, work in that way in both the areas. That can be problematic, no? So the answer is availability of DTAA benefits. Next question. Why do current accounting standards mandate recording 100% of the assets bought in and the liabilities assumed, even if the acquirer buys less than 100% of the target? They are saying that even if it is less than 100%, if it is more than 50%, then you record the entire 100% in it. So they are asking, why do we do this? To overstate the value of the acquisition, to facilitate the comparison across the various transactions, to obscure the financial statements, or to avoid recognition of the non-controlling interests. See, this is a mandate because now in this case you want to make sure that the comparisons are easier. Otherwise, it becomes very difficult to compare if one organization is at 70%, one is at 100%. How will you compare all the industries in that particular industry? How many companies are there and how do you compare them? There should be something in which you can actually make the comparison easier. So you have a specific rule, make it up to 100% there, show it in your books of accounts so that we can compare different companies in that specific industry who are working. Next question, what must the buyer account for in relation to the non-controlling interest when acquiring a target? There is a controlling interest where you have the power there, and there is non-controlling, only the goodwill attributable to it, or only the non-controlling interest liabilities, both goodwill and goodwill attributable to it and non-controlling interest, or neither goodwill or non-controlling interest. See, one is minority and majority. So the one who has the controlling area is controlling interest. They have more than 51% in that particular company, and if they do not have it, then it would be covered in this area. So what would be the relationship there? In this case, what must the buyer account? The buyer should account, see, when we are talking about 100%, that means you are taking all of it, isn't it? So in this case, the answer will come out to be both the goodwill attributable to it and the non-controlling interest. Both would be covered here. Then, moving on to the next question. The next question says, where is the non-controlling or minority interest shown in the consolidated balance sheet? Do we show it or not even? See, because if I prepare a particular balance sheet, then where do we record these things? We have to look into the matter now. It is combined with the parent's equity. It is shown separately from the parent's equity, or it is excluded from the balance sheet, or it is recorded as a liability. What would you do in this case? Where is the non-controlling or minority interest shown in the consolidated balance sheet? When we talk about the non-controlling or minority interest, this would be basically shown separately in the parent's equity. It has to be shown that there is two things. One is controlling, that is their majority, as well as non-controlling, which is minority. Both the things have to be shown. This is majority, the one which has more than 51%, and the one which is less than that, that is minority. Done. Moving on to the next question. It says, when a firm A needs to record its shareholders' equity if it purchases 50.1% of B. 50.1% means now you are above 50%. If you are above 50%, you are a controlling majority, because whatever you say, everything is going to happen according to you. Because you have 50.1, the other one will have 49.9. So you have greater authority over the entire scenario. So it's gonna be 50.1% of the firm's net income, 100% of the assets and liabilities would be shown, or 49.9 of the B's earnings, or 100% of the assets of B. In this case, we are going to show the entire 100% of the entire company that has to be shown there. So in this case, it is 100% of the assets and liabilities of the firm B it has acquired and assumed. Because you are the controlling majority now. You are the one who has a greater control over this organization. Your control has to be specified. So can I say that when we talk about controlling, and when I talk about non-controlling, what are the differences that are occurring? This is more than 50%. More than 50%, and this is less than 50%. If you have more than 50%, you would always show the 100% of it, so that you can actually show what is happening in the organization. Okay? So this would be shown in your balance sheet as 100% to make sure the comparisons are easier, just for the comparison's sake. Okay? And then while if it is less than that, then it is called non-controlling. Done. You can note this point down. Now let's move on and talk about the next question. Now let's look at this question. It says, why is foreign owned and controlled company unable to obtain acquisition financing from Indian banks or Indian financial institutions? There are certain organizations which are not Indian. They are called FOCC. That is foreign owned and controlled. They are owning it, and as well as they are controlling it as well. So in this case, FOCCs are not allowed to engage in acquisitions in India. No, this is not that. FOCC are prohibited from using leverage in India. Indian banks and financial institutions do not provide foreign financing for foreign owned companies, or FOCCs are not allowed to issue debt for acquisitions. Basically now what happens is these FOCCs try to find an Indian company, they try to merge with them, or they try to work with them, because ultimately now the Indian companies or the domestic company will always have an upper edge over the ones which are not. Right? So when we talk about Indian companies, they will always have an upper hand over this area rather than the foreign companies. So in this case, what will happen is these organizations, they do not have a lot of help from the country. That means the FOCs are prohibited from using leverage in Indian market. Matlab, they cannot raise money through the debt in Indian market. For this, what they do is these FOCs, they try to have a JV, joint venture with Indian companies, or they have a special purpose vehicle. They acquire a domestic company. They look forward towards mergers. They look forward towards acquisitions. They look towards all those areas in an organization so that they can actually earn more. Because for that they need the Indian market, they need the growth in the Indian market, they need to have access in the Indian market, debt and equity, they need to have someone who is listed on the Indian stock exchanges as well. So in that case, raising money will not be a problem to them, because till the time they are foreign owned, their working in India is definitely restricted, right? That is why deal structuring is super important. Okay, here comes the next question. When we talk about foreign owned and controlled company, what form does the debt needed to finance an acquisition through an FOCC typically take? Equity shares, then non-convertible debentures, then comes government bonds and preferred stock. See, this market is definitely not accessible to them. This market is just not accessible. When we talk about equity and preference shares, this is not. Government bonds, again very difficult. So they are raising money through the NCDs, non-convertible debentures, the debentures which cannot be converted into any other form. Otherwise, in our country, we also issue convertible debentures. Convertible debentures are those debentures which can be converted into equity, which can be converted into any other form altogether. Okay? So in this case, this would be convertible debentures or equity or any other form which they would specify. So non-convertible debentures are the forms which cannot be converted into any other form. So this is how the FOCCs are raising money for themselves in our country, because it is very difficult to do that. When we talk about how an Indian company finance an outbound acquisition using onshore financing. Outbound means I decided to go to US in terms of growth. Now I need someone, I need leverage so that I can go to USA, so that I can buy some shares in USA and I can grow further in USA. That is what I would want, isn't it? I don't want to grow in India. Because inbound is, there are two kinds of these things. I think let's just get through the answer and then I'll show you what kind of the acquisitions are there. How an Indian company finance an outbound: by sharing equity shares, by raising loans from equity, loans from Indian banks, by issuing government bonds, by securing loans from foreign banks. Foreign banks are not going to help us. Ultimately, we are going to raise our money through the Indian banks. Indian banks are our area, na? Okay, let me talk about inbound and outbound. Inbound as well as outbound. Okay, I'm talking about the outbound acquisition for onshore financing. I'll talk about onshore as well. So inbound acquisition is when an Indian company is acquired by a foreign company. This company is trying to broaden up its horizon in India, so they are trying to buy an Indian company. When we talk about outbound acquisitions, under this what happens is, whatever our Indian company is basically going out and trying to buy a foreign company. Onshore financing is, I am getting financing from India. Okay, I need money there, but to buy some organization which is outside India, I am going to use money from India. So I'll get some bank in India, and from that bank I'll get money, and then I'll buy the foreign company. Okay, this is inbound and outbound acquisitions. Got the idea, everyone? This is simple finance, but the point is the techniques that they have specified, the kind of language which they have used. It is quite crazy. That is what I can say. Done, everyone? Chaliye, one more question to go and then we will end the session. Let's move on. This is the question, that is external commercial borrowings. What is ECB commonly used for the context of outbound acquisitions? What kind of ECBs are used in terms of outbound? Matlab, we are going out and trying to buy some organization outside India, financing domestic acquisition in India, purchasing shares of overseas joint ventures or wholly owned subsidiaries, issuing NCDs to domestic mutual funds, or establishing offshore special purpose vehicle. SPVs are basically, now, if I have to buy some organization outside, do you know about what do people do when okay, it's an illegal thing, so, but let's talk about it. It's one of the easiest way. You've heard about the word supari. If I don't want to kill someone. So what I do is I give money as an extortion to someone that I want this particular person to be killed. I don't want my name in that. So in the initial period, matlab SPVs are like this. In the initial period, there is no need to tell my name. Ultimately, I will take over the body of that particular person. Sounds weird, but let me tell you how it works. What happens is, I'm the main company. I want to buy some other company. So in this case, it is not possible to reach out to that company directly. So I make a special purpose vehicle. It can be special purpose acquisition company, which is buying all the shares of this company. Once it has got the entire company's control, this company will dissolve itself and I will get the entire company. So this is just doing my work. So special purpose vehicle can be built to manage the assets, to buy some other company. There are specific purposes for which these organizations work. Right? So in this case, what would be the answer? If we talk about external commercial borrowings, it is purchasing the shares of the joint venture. This is one of the best ways. You have a joint venture with the other company. It is like purchasing shares of the overseas joint ventures or wholly owned subsidiaries. You try to develop yourself through JVs or having subsidiaries there. This is a better way where you can grow in the other company, in the other countries. For example, Domino's is not working in our country on its own. It is working through Jubilant Foodworks Limited. Both of them have a joint venture in India. They don't have to work in India, Domino's altogether. It is working through this organization. This happens. So JVs or joint ventures or having subsidiaries makes it easier to go and commence your business in other countries, which individually going to that particular country would have been quite difficult. Okay, so that's it for the day.
Apologies. Now let's continue further. When we talk about the domestic acquisition means acquiring an organization within our country. Okay? We're not going outside. So basically, what are the forms of financing that we try to have when we are acquiring an organization within our country? Is it going to be equity shares and government bonds, or when we talk about non-convertible debentures and loans and preferred stock and foreign loans, or offshore special purpose vehicle and capital market funds? See, when we are trying to buy an organization in India, then why do we need to go out? We just don't need to, isn't it? In this case, there is no need to go out and buy something outside. So in this case, can I say that in this case it would be equity shares and government bonds? No need. Preferred stock, foreign loans, not requirement. If I have to go for foreign loans, I would go for foreign loans when I'm trying to buy something outside, not within the country. Then we talk about offshore special purpose vehicle. That's not the point there too. So in this case, it is basically, why don't we introduce NCDs and loans from NBFCs? They are way better option because I'm trying to have loans within India. That is non-convertible debentures and loans from NBFCs. Then everyone, next question. In what instances would an Indian acquirer establish an offshore special purpose vehicle? For domestic acquisition within India, to comply with RBI, to secure loans from other Indian banks, and to issue non-convertible debentures. What would be the point, everyone? In what instance, what would be the Indian acquirer establish an offshore vehicle? See, Indians also go outside. They will also have a special purpose vehicle. If I want to grow outside India, why would I be just thinking about India only? For example, companies like TCS went up to US even. So basically, what happens is in this scenario, they work in such a manner that they are looking forward towards domestic acquisitions within India. They're trying to acquire an organization within India, right? So when they are trying to nay, this is different. This is special purpose. Offshore special purpose vehicle is if I am in India and I would like to buy an organization which is outside India. For that I will have a special purpose vehicle. Okay. So in this case, when I have to work, when I want to buy an organization outside, I will have to be very sorted about it. How do we become very sorted about it, everyone? I will try to have it for domestic acquisitions within India to comply with RBI guidelines, to secure Indian bank loans, or to issue non convertible. This is not required. This is not required. You try to develop a special purpose vehicle because RBI has some rules there to comply with RBI guidelines on overseas direct investments. Direct investments means I'm going outside and putting my money in some foreign organizations there. Okay, so basically if I want to grow my organization, I have to be very clear in which country I'm going, what are the rules and regulations of the organization, how do RBI work, all those things has to be very sorted. What must the buyer account in relation to the non-account controlling interest when acquiring a target? Only the goodwill attributable to it, only the non-controlling interest, both the goodwill attributable and non-controlling interest, neither the goodwill nor the non-controlling interest. What must the buyer account for in relation to the non-controlling interest when acquiring a target? Non-controlling interest means having less than 50% there, you know. And what must the buyer think about this when you're acquiring an organization? I'm sorry. So when we talk about this area, in this case, you cannot think only about the goodwill. You cannot think about only the non-controllable liabilities there. I have to think with the broader prospect. I have to think about both the goodwill as well as the other scenario. That is both goodwill attributable to it and the non-controlling interest. So in this case, the answer will come out to be C. Next question. Where is the non-controlling or minority interest shown in the consolidated balance sheet? It is combined with parent's company. It is shown separately from the parent's equity. It is excluded from the balance sheet, or it is recorded as a liability. It is better visible now. What would be the answer in this case? In this case, the answer would come out to be B. It has to be shown separately in the parent's equity. If we talk about this area now, we are talking about the area of non-controlling minority interest. They have to talk about the non-controlling part has also be to be reflected now. So this would be shown. separately. The parent company is going to show that there is a minor company which is existing there. It has to show this as well. What does a firm A need to record in its shareholders' equity if it purchases 50.1% of B? So A has acquired B and 50.1%. That means it's a controlling organization. It is basically controlling, and that will majority. It has got 50.1% of the net income, then 100% of the assets and the liabilities would be covered here. You know, so in this case it would be 50% or 100% or 49.9 or 100% of the firm. See, when you are acquiring more than 50%, the organization, the decision making is all yours, isn't it? So in this case you are bound to show, don't have a choice, you have to show 100% of the assets and liabilities of the firm that is acquired and assumed. What should be the decisive factors in mergers and acquisitions according to the information provided? Accounting concerns, tax benefits, core economies or economics of the sale, or legal structure of selling entity. What should be the decisive factor in mergers and acquisitions according to the information provided? See, when we are trying to have a merger and acquisition, merger means you're trying to merge with another organization, and when we talk about acquisition, it is when you're acquiring an organization. It is basically what are the things that you have to look forward to. See, is a factor, because all these are required. But see, accounting concerns become secondary. If you want to acquire the organization, then everything else becomes secondary. So in this case, it would be based upon, see, my organization produces 10,000 units. The other organization produces 15,000 units. Combined, we become 25. This is good. This is what we would want if we capture more of the market. So, for example, I capture more than 25% of the market. He captures around 30% of the market. Combined, we are going 55. That means we are going to rule the market, isn't it? Ruling the market is what we would want, don't we? So, in this case, can I say this is going to be the core economies of sale only? That's the point that we are looking forward to, covering or capturing the market. In the context of acquisition, which party is primarily concerned with assessing the tax basis? Buyer, seller, the shareholder, or regulator? The question itself is very interesting because it is talking about acquired assets. Acquired means bought. Bought means the buyer. He is worried about the fact that how is he going to show it in the books of accounts, isn't it? He has to show all this in his books of accounts in a certain manner. So that would be covered here. The answer would be buyer. What does the term tax basis refer to in merger and acquisitions? The price paid for the acquired company, the level at which the assets can be depreciated, the value of the combined firm after acquisition, and market value of the target organization. What does the term tax basis mean? As such, do you know in terms of mergers and acquisitions there is no tax on it? There is no tax on it. What does the term tax basis refer to in terms of mergers and acquisitions? See, the point is tax basis can be based upon the carry forward of losses, or it can be based upon the depreciation of the goods. So, right? If the particular asset was acquired by previous organization, now it is carried on by the current organization. How are they looking forward to it? Because the combined value is not the point. Market value is never the point, because you are not looking forward towards the market value. Price paid for the acquired company is not the point too, because in terms of shareholders, it is exempt. For the company which is selling it up, for them it can be taxable, but for the buyer it won't be again. That means if I look at the entire scenario, the taxation that is basically creating a problem is the level at which the assets can be depreciated. The coolest part is that if this organization, first organization, was using it for 120 days and the remaining days was taken over by the other organization. For example, we have 365 minus 120. We get 245 days here. This makes 360. This is in the earlier organization, that was, for example, the amalgamating company, and this has been now taken up by the amalgamated company. So in this case, the depreciation would be charged accordingly. In this organization as well as this organization, it would be differentiated between the two. That's the point regarding the portion of amalgamation in terms of tax basis. The level at which an asset can be depreciated. Which type of transaction is not considered taxable to the shareholders of the target company? Cash purchase of target assets, stock purchase of target assets, equity, or none? See, if I had shares of company A, now I got the shares of company B. This is not taxable. What is taxable is if between the two companies the problem arises when we are having an issue regarding cash purchase of the target assets or stock purchase. Stock purchase is not a problem because you had shares of this company and now you have shares of AB. This is not a problem because you didn't get even a single penny. The moment the cash is paid, the entire taxation thing becomes taxable. The moment there's a cash purchase. If there is no cash purchase, there is no such problem there. But if there is, then there's a problem.